In this video, we are going to be talking about net present value and internal rate of return. If you're a contractor or a tradesman and you are not trained in financial terminology, but your business has grown to the point where the meetings that you are having with customers, terms like net present value and internal rate of return is mentioned, then this video is for you. We're going to discuss four things mainly. First of all, general concepts. In other words, what is net present value and internal rate of return, and how do we understand the concept? If you look at most of the YouTube videos, everybody would talk about the future value of money. Future value of money has no reference for me, and I don't understand the term future value of money. So we're going to be looking at this from a different angle and trying to understand what net present value is, how we can apply it to solar PV systems specifically, because we've got a lot of contractors that are busy, started off small, they've grown their businesses, and now they're having uncomfortable conversations in boardrooms, and hopefully with this video we'll be able to cover the basics. So general concepts, then we're going to have a look at values and origins. So in the net present value conversation, you have an investment amount, you have a discount rate, and then you have the returns. You have three basic values, and we want to have a look at where these values come from, how do we determine them, and who's responsible for identifying what they are. Then formulas and an Excel example. I want to, in this video, have a look at how we do net present values and net present value calculations in an Excel spreadsheet without using the net present value and the internal rate of return formula. In other words, we're going to be looking at the bare formula. I'm going to write down the formula on the board. We are then going to put the formula into an Excel spreadsheet so that it's going to be easy for you guys to determine the net present value for your customers if you are going to be proposing costing or projects in PV systems or energy solutions. Then after we've done that, we are going to look at where these values come from in solar PV systems and how we use them in the calculation. And guys, hopefully after that, you'd be able to have a comfortable conversation on net present value and internal rate of return. Let's quickly start with the general concept. So you're a contractor, you are extremely busy, you've got one team with one vehicle, and the team goes out every day to do projects. But while they are out doing projects, you've got inquiries coming in, and you can't field those inquiries because you only have one vehicle. So what you are busy identifying is how much money you are busy losing because you don't have that additional vehicle or resource in your business. So the only way that you can really fix that is by investing money into buying a vehicle. With the general concept of net present value, the general concept looks at making an investment and then using the returns to determine whether the investment is a good investment. Most contractors don't do business in this way. They would look at the amount of work that they are losing. In other words, they would quantify it, but they'd quantify it in the back of their mind. I'm busy losing work here, losing work there, losing work there. I think if I buy another vehicle, the vehicle will pay for itself because of the amount of work that I'm losing. They don't necessarily quantify it They end up buying another vehicle because there's demand for it. When we look at net present value, we can use that concept to understand, we can use the concept of a contractor's business growing to understand the net present value in a business. So a contractor identifies that he's busy losing work. He decides that he is going to be spending money on another vehicle. So he buys another vehicle. I'm just going to use a random amount of 70,000. It could be anything. It could be rand, rupees, kwacha, dollar, could be yen, could be any kind of currency. I don't want to specify currencies. We've got guys from all over the world looking at these videos, so I want to try and keep it currency neutral. So you've got an investment of 70,000. You guys can just add your own currency to that. But you've got an investment of 70,000. That is a negative amount because you've got it's money that's leaving your pocket or leaving your account. And for year one, the asset that you bought or the tool that you bought brings in a value of, let's make it 30,000. So you are generating an income in year one with the 70,000 that you've invested. In year two, you are going to generate the same amount. So we have to draw a lot of conclusions. That's the only way that net present value works. So we're going to use year one, year two, and year three with the same value. With solar systems, these values are going to vary depending on the amount of income that is generated. So a solar system has a slightly different dynamic, but we need to understand what these values are first before we get around to it. So the general concept is that we've got money coming in because of a resource that we've acquired, invested in, bought, or capital we've made available so that we can increase our turnover. So we've got the 30,000 every year coming in. If we add these three values, that comes to 90,000, and we deduct it off the 70,000, so we end up with a 20,000 in profit. So, which means that our tool we've invested in will be paid off before the 3-year term is over. But now there are additional costs. This is not a straight up calculation. In order to get to net present value, we have to identify something that adds a cost to this value over here, and the cost it's going to add to this value is going to be added every year. What that's going to do is it's going to erode our profit. It's going to erode our profit because there are certain values. If you buy this tool or this vehicle, you have certain costs in order to maintain the vehicle. So I'm not talking specifically about maintenance costs. There might be depreciation on the value on the vehicle. There might be maybe it's the insurance cost you want to use as a value to derate or to reduce this value, to give you a clearer or more accurate understanding of what it is that it's actually going to generate and what that value is going to be. So in order to determine that, they identify something that is called a discount rate. So a discount rate is anything from could be 5 to about 10%, could be 2 to about 20%. So it has a very broad range, and the discount rate is normally determined by the client. But in this case, you've got your vehicle. Maybe you want to use your insurance costs. Maybe you want to use the financing costs. Maybe you want to identify costs in your business that is directly related to the use of the tool or the resource, and that discount rate is going to derate it. So let's use, I just want to use a simple example without thinking about it too much. I'm going to use 12% as a discount rate. So what we will do is we'll take that value and we will divide it by 1 plus the discount rate. Should we call it X? Let's call it, I'm going to call it 1 plus 12%. And then over here, it's going to be to the power of 1. For year 2, it's going to be that value divided by 1 plus 12% to the power of 2. And over here, it's going to be 1 plus 12% to the power of 3. So that's for year 1, that's for year 2, and that's for year 3. All 3 of those values are going to be added to one another. Let's just see where we are in the program quickly. We've discussed the general concept. We've looked at the values and origins. We said we've got 3 basic values. We've got the investment amount, we've got the discount rate, and then we've got the income generated by the resource. So we've got three basic. I see we've got a bit of glare on the board over there, so I'll write that over there. We've got three values. We've got an investment amount, return, and a discount rate. The discount rate, we said, is something that you determine. We'll have a look at the discount rates and what they could represent in solar systems when we get to this last item. So we've discussed general concept, we've discussed values and origins. If we look at formulas, that's the formula you have over there. And in a solar PV system, this formula could stretch over a number of years. Could be 10 years, could be 15 years. If you provide financing, it's normally between 10 and 15 years. If you want to look at the full life cycle of a solar PV plant, you could use the full 25 years. You could use 10 years because the warranty on the inverters are 10 years. You could use 5 years because the customer wants to see what the return is over a 5-year period. The number of years you use could either be determined by the customer. Maybe the customer wants to have a specific return. We've just had a project where the customer said that they wanted to have a 25% return in year 1. So that changes this discussion because now the customer has identified how they're going to evaluate that project, and then you need to make sure that you can reach 25% in year 1. That is not a net present value calculation. That is a return on investment calculation, but that's not where this video is heading. So we've got the formulas on the board. We can stick this into an Excel spreadsheet quickly. Okay, guys, so we've got our Excel spreadsheet. It's open. We are going to put our investment amount in there. We are going to put our discount rate over there. And then we are going to have 3 years. We'll have year 1 there, year 2, and year 3. So our investment was 70,000. I want to move those up a bit, maybe there. our investment was 70,000. We said that our discount rate was 12%. And then if we want to put our returns in there, so we said that we were going to generate 30,000 as a return per year for every year. So the formula is equals to the sum, parentheses, we want to put our return value in. So it's going to be the return divided by another parentheses. And then it's going to be 1 plus the discount rate, close parentheses, to the power of 1, close parentheses. Let's see if that works out. 26,785. Now the next one, we could just drag this across, but if we drag this across, we would just have to change the power value of the discount rate. So that one is going to be, let's just type it out, sum. But now it's going to be that value divided by 1 plus percentage closed to the power of 2, close parentheses, enter. And for year 3, it's going to be equals sum that value divided by 1 plus discount rate, close parentheses, to the power of 3, close parentheses, enter. So the values we had for year 1, year 2, and year 3 has actually reduced in value because of the discount rate and the costs we've allocated to the investment we made in this resource. Now, if we add all 3 of those values, and this is a proposal we have to give to a customer, typically if the sum of that is greater than the investment, then the customer will end up probably investing in this because it's a good deal. I'm going to add another year. So I'm going to say equals sum that divided by parentheses 1 plus discount rate to the power of 4, close parentheses, enter. That value is supposed to be a minus. That's supposed to be a negative because it's money we've spent, money that has left our account. So that's a negative, and those values over there are positives. So now we can take the net present value is equal to that plus that. So it's equal to that plus that plus that plus that plus that. And then if we hit enter, we'll see that our value we have over here is a positive value. So after 4 years, the total return we'll receive on the investment we've made is 21,120 units of whatever currency you'd prefer. So because the net present value in this case is positive, we'll probably end up doing that investment. So what I would like to do is I want to, for the next section where we want to discuss internal rate of return, what I want to do is I want to change how this formula relates to the value. So I want to turn this value into a factor, so that when I change the discount rate over there, it'll show us the difference over here. So what I'm going to do is I'm going to put, let's put here, there, that's going to be 1, 2, 3, 4. I'm going to slide these numbers one row down. I'm going to put return. We're going to have a return of 30,000 every year for 4 years. So I'm going to change the formula slightly. I'm going to make this formula, I'm going to make that is equal to the sum of 1 divided by 1 plus that 1 to the power of 1 plus parentheses. So what I've done is I've changed the value of 30,000 Rand with a 1, because what I want to end up with is I would like to end up with a factor. And what I'm going to do over there is I'm going to put a $sign in front of the C and a $sign in front of the 6. And what that does is that locks that cell. I'll show you guys what it does in a second. So we've got our factor over there. Now, if we go to the corner of our Excel cell, you'll see that the cursor changes. The cursor goes from being white on the inside to being black on the inside. Right there where it hits black, I want to left click and pull. And what that does is that is going to expand the calculation. That's going to expand the formula to all the cells. I need to change that one to the fact that has to be to the power of 2. I have to change that one to the power of 3. I have to change that one to the power of 4. So those are our factors. So I'm going to call that factors. And maybe let's just draw a border around it. Let's put some borders through and a nice thick border around it. So those are all our factors. Now, okay, so because we have the factor over here, we can multiply that value with a factor to give us the answer. And this answer should be the same as that answer over there. So this is what we're aiming for. That is what we did manually. I'll show you guys in a second why we do this. That's what we did manually. And this is going to do it for us automatically. So we're going to say that one is equal to the 30,000 times 0.89. And it gives us the same value. I want to add those. I want to change the format to currency. No currency. Okay. So now if I drag this across, it should give me the same answer as the answers we had at the top. The only difference is we've automated our workflow, because now if I change my percentage, if I change my discount rate, it's going to change those values automatically. I'm going to make them purple borders. So now if we change our discount rate, I want you guys to watch those values. If we change our discount rate to, let's change it to something that's obvious. I'm going to change it to 30%. Look at how it has changed the values. So it's changed the values automatically. So this is amazing because now we don't have to do everything manually. So what we can also say now is we can say that the net present value, so that was the one we did. I want to change the color to green because that represents the top row and this represents the bottom row. So this should be the same. So we use different formulas. We use the same formula but applied in a different way. So you have more than one option. So this one is going to be equal to the sum of that one plus that one plus that one plus that one, enter. Okay, so they are the same. Now, you will note that obviously if we change the value over there to 10%, all of the values adjust automatically. I think what I want to do is I want to change this. I'm going to make that investment value over there. So investment. I want to change the full. I'm going to make that one is equal to that one. And then over here, I'm going to make that return is equal to the sum. I can just drag that across. So now it has totaled. We have our investment in that column. We have our return in that column. And now the investment and the return can be seen right next to one another. Now, the net present value, I want to move that a bit so it's a bit neater. I'm going to put some blocks in there and a thick border around it. So the total, I want you guys to see how interesting this is going to be. I'm going to just say sum. I'm going to add those two to the sum of those two. So there is 25,000. Now, so our net present value at the moment is 25,000. If we change the percentage, the discount rate to 20%, it's going to reduce that value to 7,600 units. I want to change the color over there. So what I'm looking for is I want that value as soon as that value over there is 0. In other words, when our investment amount is the same as our return amount, that'll be our internal rate of return. So if we take that up to 25%, look at how our net present value is coming closer and closer to being 0. I want to make that 26. 26 is too high. I'm going to go 25. 25,5. I'm going to go 25,6. Going to go 25,68. 25,67. Guys, so that is our internal rate of return. Our internal rate of return is when the total we have over there, in other words, the investment in comparison to the return, is equal to 0. So our internal rate of return in this example would be 26%. We can go back, we can change our discount rate back to what it was supposed to be to start off with. And that gives us the breakdown of all of our calculations. So we know our net present value for after 4 years worth of returns worth a 70,000 investment. The net present value is 21,120. So this is a good idea. We're going to end up with a positive. And the internal rate of return is 26%. Now, how does this relate to solar PV systems? If you guys are still with me, if you're following me, that's great. If you're not following me, stop, go back, watch the video again. What we want to have a look at now is where the values are coming from for solar PV systems. The customer is going to be paying an investment amount for his solar system. He's going to be earning a return. The return is going to be given by, so the return we have over there. If you guys have simulation tools like Helioscope or Open Solar or PV Syst, that simulation gives you the amount of megawatt hours per annum that your customer is going to see as a return from the system, from the benefit of having the system. So you are probably going to take the megawatt hours, you are going to allocate a percentage to the megawatt hours because they won't be using all of the power. So you'll take the energy value and you will allocate, depending on whether the megawatt hours generated by the solar system has losses included in it or whether the losses have been taken out. If it's a bulk value, you will deduct losses, and that will give you your net megawatt hours, and then you will deduct a usage factor. Maybe the customer only works 5 days a week. Maybe they don't work over weekends, so they won't be able to benefit from the energy generated over the weekend. So the usage factor is going to determine what these values are over here. So and the other thing that you would also make provision for in year one, your system is going to have 2.5% worth of degradation from the solar PV modules. In year two, it's going to be an additional 0.5 to 0.7%. In year three, it's going to be 0.5 to 0.7%. These values, you would actually be able to work into your discount rate. And your discount rate, you would also make provision, you can make provision for additional maintenance in your discount rate. You can make provision for degradation in your PV system. You can make provision for, I don't know, insurance, financing costs. You've got to be able to disclose to the customer what you used as a discount rate and how you justify that value. then you're going to end up with an amount every year. Year one might be 100,000. Year two might be 97,000. Year three might be 95,000. That would be because of the degradation in the modules, and then you'll have your discount rate. So it just depends on how you do it and how you want to present these figures and what the customer is presented with. But that should, in essence, if you understand discount rate and you understand the formulas, I will put this formula in the text box underneath the video. So you would be able to access it there. I'll put it in there as text, so you should be able to just copy and paste it. I will make sure that the formula in the text box below this video has been done for the same cells and rows as I've done in the example, to make it easy for you guys to copy and paste. If you have any questions, drop them in the comment box. If you need a slightly more comprehensive calculation or explanation, or you need information on more topics, you're welcome to join one of our courses. But we will continue making videos and sharing information that is valuable so that you guys can build your business and be more competitive. My name is Carl Ballack. I've been presenting on solar and engineering related topics for the last 15 years. I'm looking forward to doing it for another 15 years. And I'm still going to be sharing loads and loads of videos. I hope you've enjoyed it. If you liked it, you're welcome to like the video, leave a comment, subscribe to the channel, and looking forward to seeing you in the next video. Thanks, guys. Cheers.